Right, welcome back to Property Chat with Pete. Today we have an interesting topic lined up for you where we'll be deep diving into the world of finance once again and explaining the concept of early repayment calculations and why banks charge them when breaking a fixed rate loan. So before we jump into it, remember this is not financial advice. I am not a financial advisor. This is simply an opinion based on previous experience and research. So let's jump into it. So let's demystify the concept of early repayment calculations. Now, you may have come across this term when dealing with your mortgage or fixed rate loans. But what exactly does it mean and why do banks charge it? Well, let's start with the basics. An early repayment calculation, also known as an early repayment fee or break cost, is a charge that banks impose when you actually decide to pay off your loan before the agreed upon terms ending. Okay, so this charge is particularly relevant when you have a fixed rate loan. You see, when you actually take out a fixed rate loan, you and the bank enter into a contractual agreement and you agree to a fixed interest rate for a specific period, usually several years, 1, 2, 3, maybe 5. And this stability is beneficial because it protects you from fluctuations in interest rates during that time. However, when you decide to break that fixed rate loan before the agreed term, it creates a problem for the bank. The bank has calculated its lending rates based on certain assumptions and projections, including the interest rate that they expect to earn from your loan over the fixed period. They've also taken into account what potentially they would have to pay for money if they were to use money from another country to borrow and lend it to someone in this country. So when you break the loan early, the bank loses the opportunity to earn expected interest. And obviously to compensate for the loss, banks charge an early repayment fee, which is essentially a way for them to recoup some of the foregone interest. And this fee can be quite substantial and can vary depending on factors such as the size of the loan, the remaining term, and the current interest rates, as well as what they potentially paid for the money when they brought it over from another country to here. So you may even end up not paying any early repayment costs, depending on the rate at which they bought the money for. So now before we actually look at it further, a question you would ask yourself, why would anyone want to break a fixed rate loan early? Well, there can be various reasons. For example, you might find a better deal somewhere else. You might want to refinance to take advantage of your lower interest rates, or you might have come into some unexpected funds that could obviously allow you to pay off the loan sooner, or you may be selling your property for whatever reason, and therefore you may need to come out of the fixed rate loan. Now, just remember that before I talk about that a little bit further, you can actually substitute your loan with a new property. So if you've purchased a new property, you can actually just transfer the loan over to the new property, and the bank sorts out the settlements and everything in the back end. Again, as per my previous episodes, if you need any advice or guidance on any of this, reach out to me. Go to peterharleyconsulting.com and fill out the form there, and I can get one of the property specialists to get in touch with you and speak to you further from there. So it's important, obviously, to note that not all fixed rate loans have an early repayment cost, like I mentioned earlier. Some loans may have more flexibility and allow for early repayment without incurring any fees. So if you think you might need to actually take that option to pay off your loan early, it's always a good idea to carefully review your terms and conditions before actually signing up. So remember, the early repayment calculation is a way for banks to protect themselves against the potential loss of expected interest when a fixed rate loan is broken. It's essential to consider this factor when planning your finances and exploring your options. So that's all for today's episode, folks. I hope this discussion has shed some light on the concept of early repayment calculations and why banks charge them when breaking a fixed rate loan. As always, do your due diligence and read the fine print and consult with a financial professional if needed. And thank you once again for tuning in to Property Chat with Pete. Stay tuned for more exciting episodes where we explore the fascinating world of property. And until next time, happy investing, nesting, developing, and whatever it is you're doing in the property space, whether it's your first home or investment. So thank you so much for tuning in. And remember, if you enjoyed today's episode, be sure to subscribe and leave me a review on your favorite podcast platform. And also feel free to reach out with any questions or topic suggestions. Until the next time, take care. Remember, my website is peterharleyconsulting.com.